Hello everyone. Once again, we were reminded of super volatility in commodities as they fell across board after two straight weeks of gains. It was more of a retracement in metals, but oil witnessed a sharp fall. Let's understand what led to fall in commodities and what's in store for us in the week in our latest edition of a weekly commodity podcast. I'm your host and guide Ravindra Rao from Kotak Securities, Commodities Research Desk. And as always, I'll take you through the fundamentals that have an impact on commodities along with the price action for the week. Last week was dominated by US data prints, including US PPI, that is Producer Price Index, and retail sales, statements by Fed governors, and COVID situation in China. US PPI indicated that the inflation in US is cooling down. As per the Labor Department's report, US Producer Price Index rose 8% year on year in October as compared to September's reading of 8.4%. Economists have forecasted for a reading of 8.3%. Better than expected PPI print took the dollar index to a 3-month low near 105.34. Cooling inflation as indicated by October month CPI and PPI has cemented the expectation of a slower pace of interest rate hike by the Fed. Then came the US retail sales data on Thursday that rose 1.3% in October after being unchanged in September. Although it was expected that a strong retail sales number would trigger a recovery in dollar, but that did not happen immediately as the probability of a 50 basis point hike in December remained above 80% as indicated by the CME Fed Watch tool. The US dollar, though, got some support as Fed officials hinted that monetary policy is not sufficiently restrictive. This added to the ambiguity of Fed's stance on interest rate decision and helped dollar recover from 3-month lows near 105. The US dollar index ended the week with a gain of 0.60% and closed near 106.93. This week will be a holiday shortened week in the US on account of Thanksgiving Day on 25th. Focus will now shift to Flash PMI numbers from US and Europe along with the FOMC meeting minutes. If the PMIs come in better than expected, US dollar would rise on expectation of a higher rate hike by Fed. On the flip side, if it comes weaker then it would benefit commodities on the likelihood that the Fed might slow down the rate hikes. Minutes of the FOMC November meeting will also be closely watched by the traders as any dovish indications might trigger an upside in commodities. However, if the language turns to be hawkish, commodity prices might fall. Additionally, a PBOC is scheduled to announce its decision regarding 1 year and 5 year loan prime rates on Monday. Although PBOC has kept the interest rate steady since last 2 months, there will be pressure to cut the interest rates given the dovish developments in the form of weaker economic data due to COVID shutdowns. A rate cut by China would be positive for commodities as it would help in reviving the demand. Last week we expected US dollar index to test 104.60 which we mentioned in our last podcast. The index fell to 105.34 and recovered. Immediate resistance remains near 107.50, whereas strong resistance would be near 109.50 to 110. Rallies towards 107.50 would attract selling. On the flip side, a rise over 110 on a daily closing might indicate a short-term bottom. On the commodity specifics, precious metals fell on profit taking after strong 2 weeks of gains. COMEX gold fell by 0.85% and closed at $17,754.4 per ounce, whereas COMEX silver closed at around $21 per ounce, down by 3.09%. Gold reached to a 3-month high near $1791 before correcting. Precious metals were initially supported by US PPI report and geopolitical tensions after a suspected Russian missile attack on Poland. However, safe haven bets subsided after NATO and Polish leaders implied that the missile strike may have been caused by a Ukrainian air defense missile and saw no indication that the missile strike was an intentional Russian attack. For the week, precious metals would take its cue from US data points like Flash PMI along with the minutes of the November FOMC meetings. On the price front, as expected, COMEX gold held the resistance of $17.80 and corrected. Immediate support is near $17.40, which the bears might target. However, they will have to keep the price below $17.40, $17.38 on a daily closing basis if they want to pull the prices further lower. Having said that, if the bulls succeed in holding the support of $17.40, a bounce back towards $17.80 is possible. Breach of $17.80 on closing might push the price towards the 252 DMA resistance near $18.06. On the MCX, price support zone would be near 50 to 300, 50 to 100, which might attract buying. In case of COMEX silver, as expected, the bulls failed in taking out the 252-day moving average resistance near $21.80 on sustaining basis. Support now is near $20.80 followed by $20.40. Although the bias is still positive, the bulls will have to keep the price above $21.80 on sustaining basis if they want to target $22.50. On the MCX, price closed below 252-day moving average resistance. Resistance turned support near 61,000 after staying above the same for almost a week. Having said that, it will be interesting to see if the bulls take it back above the 61,000 level. If they fail, then the correction might extend till around 60,000. Coming to energies, WTI crude oil prices have slipped around 9% this week to 2-month lows below $80 per barrel as demand concerns outweighed supply side disruptions. Restart of Russian oil flows via Druzhba pipeline coupled with easing geopolitical panic after NATO stated a missile attack on Poland was not Russian eased any immediate supply related distress. Crude inventories have been mixed, with product inventory showing a build putting downward pressure on prices. Also, modest downward revision made by OPEC to both 2022 and 23 demand growth projections, citing economic challenges in Europe and China's still strict COVID policy, highlighted demand woes. Chinese have not given any indication of the reopening as COVID-19 cases surged across the nation. Economic data were also not encouraging that created doubts on oil demand from world's biggest importer of oil. Crude oil might take its cue from the PBOC interest rate decision on Monday and November FOMC minutes on Wednesday. A close below $85 supported the bear case as they pulled the prices below $80 per barrel. The next strong support is near September lows of $76 per barrel. If that is held, crude might consolidate between $84 to $76 in the week. On the MCX, support would be seen near September lows of 6290. Until that is held, a consolidation between 6290 to 6800 is possible in the December contract. Finally, in case of industrial metals, they were too weighed down as COVID cases hit 7 months high in China, and mixed signals by US economic data have added to macroeconomic stress. Supply disruptions at major copper mines, namely Escondida and Las Bambas in Chile and Peru respectively, have been unable to provide a cushion to LME copper, which slipped below $8,100 per ton from 5-month high of $8,600 per ton touched earlier in the week. As mentioned earlier, base metals might take cues from the PBOC interest rate decision on Monday. A rate cut may be beneficial for industrial metal as it would help in reviving demand that has got impacted due to the surging COVID cases in China. On the price front, MCX copper has witnessed a throwback after December contract tested a high near 711. Price has now reached the earlier breakout levels that might be supportive for price. 52-day moving average is near 662, which would act as a good support. Having said that, until 662 holds on daily closing, a bounce back or a second leg of rally can't be ruled out. This brings us to the end of this week's commodities audiocast, weekly audiocast. Keep a watch on a PBOC interest rate decision as well as minutes of US FOMC November meeting, as this would drive commodity markets in the week. All the best. Have a safe trading week.